Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Jesse Felder. So Jesse needs no introduction, but in case you don't know who he is, he's been managing money for over 20 years. He began his professional career at Stearns Co. and later co-founded a multi-billion-dollar hedge fund headquartered in Santa Monica, California. Today he works with a select group of clients at Felder Company LLC in Bend, Oregon, and blogs at thefelderreport.com. If you haven't checked out thefelderreport.com, highly recommend it. He's got some great stuff there, great blog. In this episode, we cover all things macro investing, including outlook for U.S. and emerging market equities, the U.S. dollar, inflation, gold, commodities, and we go into great detail on the forces at work driving each of these. Jesse's blog and Twitter are a treasure trove of great information on financial markets, and you won't want to miss details on how he consumes such a breadth of information about markets and the Twitter accounts that he loves. Before you listen, please don't forget to like or subscribe to the podcast anywhere where you digest these. And even better would be to leave a review on Apple Podcasts. This really helps with the rankings. There is loads of value in this episode. Please enjoy this conversation with Jesse Felder. Jesse, welcome to the podcast. Excited to have you.
Hey, it's my pleasure. Thanks for having me.
Absolutely. A lot of my listeners know who you are and your background, but for those that actually don't know, can you give a brief background, who you are?
Yeah, sure. I started in the kind of investment game right out of college. I actually didn't study finance. I was always interested in it though, but I studied English, and when I got out of school, I knew I wanted to be in a career in finance, and it actually worked out well because I think a lot of the people I admire most, believe that a lot of what they teach you in school is kind of can hinder you more than help you in terms of the market. So, but I went to work straight away for Bear Stearns in LA, in Century City, actually. They sent me back to their New York office to tour the floor of the New York Stock Exchange with their head trader. At the time, Bear was doing more business on the New York Stock Exchange than anybody else. So that was a great education. I worked at Bear for a little while, just kind of in the private client side of things. I found a guy there who was essentially running kind of a hedge fund inside Bear, and we ended up leaving to start our own fund and firm, and that would have been late '97. From late '97 until March of 2000, really the run up, the final run of the dot-com mania through '99 and early 2000, I was the head trader of this hedge fund firm, and really had a front row seat to that. And I quit. I quit the firm in March of 2000, literally right at the top. I wasn't trying to time it or anything, but I had there was for a number of reasons. It was a good time for me to leave, and I moved to Bend, Oregon, and essentially been just managing my own money and writing about the markets ever since.
What a time to leave. March 2000. Couldn't have top ticked it any better than that, probably, right?
Well, I think, so many things go that way. There was so much, emotion and part of our discipline, we were supposed to have a value mandate. And so my partner at the time, who was the head portfolio manager, was, wanting to abandon all of these value stocks and dive into the, all the, most popular momentum names. And it kind of, came to a head right around that, naturally during that March of 2000 peak when, there were so many terrific opportunities in value, and we were moving away from those and into these things that were just about to implode. And so, our relationship was kind of, imploding at the same time. So.
Absolutely. So I actually wanted to start with something a little bit different, but I think this is a perfect segue. Something you shared today on your Twitter, which is a fantastic resource for any of my listeners, by the way. And I definitely want to get into that. But the FT article about the US stock market bubble and the comparison to Japan in the 1980s. And one quote from it was that 530 out of America's 8,500 listed companies trade at more than 10 times sales. And this reminded me of one of your articles on your blog as well, the What Were We Thinking, what part two, Deuce, that I actually will link as well. But I mean, at 10 times earnings, 10 times sales rather, these are just bonkers valuations. So let's just jump right into it with your current view of the stock market. This is recording on September 8th. So some of the mania from last week has kind of come back a little bit, but they're still just so stretched. So let's dive right into it. U.S. stock market.
Yeah.
What are your thoughts here?
Well, it absolutely is another speculative mania similar to that Japanese, bubble that peaked in the late 80s, early 1990, and to the dot-com mania. I probably should qualify this by saying that, it's through just anecdotal evidence. I've noticed that depending on when you come into, Wall Street as a career, that the first couple of years are very make a huge imprint on the rest of your career. And so for me, coming into the middle of the dot-com mania, watching this, just huge pyramid scheme is what it, felt like to me at the time. That's colored me towards, being more, wary of those types of things. And so but I do think this is very similar in the respect that, yeah, you can look at valuations. I was just right before we started recording looking at another valuation measure I use. And that's basically just taking the three biggest stocks in the market, Amazon, Microsoft, Apple, and you look at the price to free cash flow. And at the I think they peaked valuation wise in December of 99 at about 45 times free cash flow. I'm talking about aggregate free cash flow. So take the three market caps, put them together, take all the cash flow those three companies create, and just create a ratio. And so it's on September 1, they hit 48 times free cash flow. So they even got more expensive relative to free cash flow than they did at the peak of the dot-com mania. And that was with Amazon generating no free cash flow and what have you back then. So yeah, but on a price to sales, I think is another interesting one to look at, because you look at Tesla. To me, that quote, that "what were you thinking," comes from Scott McNealy, who was the CEO of Sun Microsystems back in the day. His stock went from $5-6 a share to $65 a share, like in several months' time. Very similar to Tesla, up tenfold. And it traded over 10 times sales for basically, a networking computer, server type company, hardware maker. And so you can never really have amazing margins to support that type of evaluation when you're a hardware company. But I think Tesla recently got up almost to 20 times sales. I haven't looked at it, but it was 14, 15, 16, 17 times for another company that will never have the margins to support something like that. It doesn't have the sales growth either. I mean, Tesla's sales growth is flat to negative right now. So the valuation is absolutely insane, even more insane than Sun Microsystems was, back at the peak of the mania. And I do think Tesla will prove to be that kind of, iconic, poster boy for the bubble that we're watching right now.
In that article, I mean, Scott McNealy's quote is just, for the listeners that perhaps don't understand what 10 times revenue means, is that if they pay out 100% of their revenue for 10 straight years, so they have zero expenses, zero R&D, all of this, and 100% of their revenue is paid back, it will take 10 years. So for Tesla to be above that, I mean, you're pricing in just crazy growth into these numbers, right?
Yeah, and it's not just Tesla. I think this is a really important point that I think a lot of, Tesla fans would say, okay, well, this is not just 10 years of growth. We're pricing in 20, 30 years worth of growth.
Right.
And the earnings might not even materialize in the next 10 years. They would maybe point to Amazon. Look at, you paid 10, 15 times sales for Amazon in 2000. You still have done pretty well, on owning, even if you bought the stock at the peak back then. So they're saying over, a 20-year period, you could have the growth that, comes in to justify that. But I think when they're doing this with Apple, right? I mean, when you're willing to, Salesforce.com is another great example, trades 200 times free cash flow, right? Gosh. It's 0.5% free cash flow yield. And so when people are saying, okay, well, that's fine because interest rates are zero and because Salesforce is going to grow like crazy for 20 or 30 years. The further out you project that, the more room for error you are allowing, or actually less room for error you're allowing in your analysis. Because if interest rates don't stay zero for the next 20, 30 years, right? If interest rates go back up to 5-6%, all of a sudden your discount rate and that discounted cash flow model has to go up, and the valuation comes way down. So you're making that bet that interest rates are going to stay zero for 20 years or 30 years. You're also betting on them being able to grow earnings or grow sales or whatever it is at a 5, 6, 7, 10% for 10 or 20 or 30 years. If that growth rate, just assume earnings, do 5% a year for 20 years or 30 years. If that growth rate ends up being 3% instead of 5,
Right.
your valuation's cut in half. And so there's so much duration risk, I think, in equities right now. You typically think of duration risk in bonds. Like, okay, I'm gonna buy a 30-year bond. I'm gonna go way out on the curve. And if interest rates do, a little bit of movement, it makes a huge difference in the price today. That's the same thing when you're making a 30-year bet on a stock. That what interest rates do and what the growth of that company do has a massive change in the valuation you come up with today. So I mean, I just was writing about this recently. If you use a 5% discount rate and assume a 5% growth rate, you can get you can come up with a reason to spend pay 100 times earnings for a stock. But if that discount rate goes up 2% and the growth rate comes down 2,
Right.
you're only looking at a 10 times multiple instead of 100 times. Literally, the valuation came down 90% by those small changes in the adjustments that you're making. So I think today investors are taking this duration risk in the equity market, more duration risk than they've ever taken before, and counting on this earnings growth to sustain for a long period of time, and counting on interest rates to stay very low for a long period of time.
Yeah. And I mean, this time it's different, right? There's a number of factors. Like, I don't see rates ever coming up, or just how that's even possible. And we'll dive into that in more detail. But you've written as well about the passive investing bubble and these sorts of things, as it's just this self-fulfilling prophecy because they're market cap weighted and money's flowing in, so it's going to these bigger companies. I mean, what are your thoughts of this time it's different with these different factors that are flowing into it, and how do you think through how these are impacting stock market valuations?
Yeah, I think, I mean, this time it's different is,
Classic.
right. John Templeton, famously said 4 most dangerous words in finance this time is different. And, people have been saying that for 5-6 years, and there hasn't been, any consequences for that. People believe this time is different for so many reasons. They believe that valuations don't matter anymore. You hear a lot of people say price to book doesn't matter anymore as a valuation tool, because so much of the value is in intangibles now. And I mean, you can come up with so many different different arguments. But at the end of the day, this time is much more similar to it was in these past manias than it was, and to think that this is the beginning of a new bull market, I think is absolute, insanity, because there's so many parallels to past market peaks. And you're right. To me, I see two manias at work presently. One is the passive mania, which has been going on, like I said, for at least 5, 6, 7 years now, which people believe that the price you pay does not determine your rate of return any longer, which is, the cornerstone of Buffett's success is the price you pay determines your rate of return. Pay a cheap price, get a high rate of return. Pay an expensive price, get a low rate of return. Passive investors think, I can just come in and pay any price. I can pay the highest price in history, and I still deserve a historical rate of return. I still deserve an 8 to 10% rate of return, which is, that in itself is manic thinking.
The thought there is that on a long enough time frame, like I'm putting this money in for 30 plus years, the historical average is 8 years. So over this time period, like it's a blip on the radar, right? Is that kind of the main argument?
And I think
there?
that goes with another, George Soros said, every bubble has, these mistaken beliefs that support it. And one is that the price you pay does not determine your rate of return. Another one is that no matter, the price I pay, as long as I hold on long enough, I'll always be made whole. That, the market always, has never had a 10-year period where you've lost money or a 20-year period where you've lost money. If as long as I have a long enough time frame, I'll be made whole. And that's another mistaken belief. I think that if you look back at the history of the U.S. stock market, especially in real terms, I mean, if you bought in the late 60s, you had 30 plus years of losing money in terms after inflation. But if you bought at the 1929 peak, there was 20 plus years where you were underwater on that investment. And I think the point that I would make in relation to that is that today valuations are higher than they were at the 29 peak. So it's certainly possible that we have a 20-year period where if you buy stocks today, 20 years from now, you could still be underwater. And Japanese investors would be the first ones to say, yeah, look back at 1990. We're still, 30% below that peak from 30 years ago. So, that's another mistaken belief. But, those are the ones that I think are driving this passive bubble. Let's just put money in stocks no matter what. But there's also, a retail, a classic speculative mania going on right now in the options market that, we can talk about if you want.
Well, the option market alone, I mean, these call options, massive quantity of call options. The key takeaway there is that it's displaying a lot of these peak mania characteristics. So it's fair to say that you're not that bullish near term or longer term on the US stock market as a whole, probably. And I don't want to put words in your mouth, but are there pockets of value? I mean, maybe eventually we'll go back to value investing one day, or emerging markets, or anything within these markets that actually, might make sense on a longer term horizon?
Yeah, I mean, I do think emerging is attractive relative to more developed markets. Emerging is cheap, on its surface, and it's also cheap from a currency standpoint too. I think the dollar's overvalued, and so but in terms of the U.S. stock market, I do think this is probably one of the most dangerous times to be an equity investor in history, short term and long term. I think there's the very good possibility of another, lost decade where there is no money made over the next 10 years, and there's a good chance actually investors 10 years from now will look at a loss even after dividends are included over a 10-year period from today's prices. So I think it's extraordinarily important to understand that risk is there in the market. For the possibility of a 50, 60, 70% decline in equities is as great as it's ever been. And so, I think for a lot of investors to think back, okay, that 2008 experience, that 2000 to 2002 experience, those are what typically happen as a result of a bursting bubble. And I think we are in the process of, a large topping pattern, a bursting bubble, whatever you want to call it. And the only reason that it hasn't burst as part of, the COVID induced recession, global recession, is that we have seen an unprecedented amount of money come into the market in the form of stock options that has really kind of created this final blow off in the NASDAQ.
Yeah, I completely agree. And this whole, Tina, there is no other alternative is very dangerous thinking. So you touched on it briefly, bearish on the dollar, a number of reasons. Can you touch on why exactly you're bearish and what those reasons are?
Yeah, sure. There's, the two longer term drivers that I look at for the dollar are, one, its valuation relative to its peers. You can look at, purchasing power parity or any type of, the Big Mac index is a good, shorthand for, what does it cost to, produce a Big Mac in the United States versus other places. And you can do that. Basically that's a shorthand for purchasing power parity. And that's just the valuation of the dollar versus other currencies. Dollar's overvalued, versus, almost every other currency on the planet. And the more important one for me, fundamental driver for the dollar, is probably the fiscal situation. If you look at the deficit to GDP, the dollar tracks that pretty closely over longer periods of time. You'll get a 20, 30, 40-year chart, and you'll see that, when the deficit is widening, then that's usually bearish for the dollar. Now, the deficit started widening when the dot-com mania burst. Tax revenue went down 2001, 2. The deficit started widening for 2 years before the dollar really rolled over hard in 2003, 4, 5. And so sometimes it does work with a delay, but when Trump, initiated these corporate tax cuts and created $1 trillion deficit during an economic expansion for the first time since the 1960s, when Nixon was trying to pay for the Vietnam War, that to me was a major red flag in 20. And then we saw, the dollar roll over pretty hard in I think it was 16, 17. And then it's rallied, since, but the deficit has since widened, much more dramatically as a result of, falling revenues now. Well, it was falling revenues from the tax cut, but, now it's falling revenues plus massive fiscal stimulus, 2 trillion in spending, 3 trillion in spending, whatever the numbers are, creating a massive $4 trillion, deficit. So that historically has made people wary of owning dollars, and say, especially when the dollar is overvalued, those two dynamics together, the deteriorating fundamentals paired with the dollar being overvalued, to me point to another major bear market for the dollar over the next few years.
Yeah, and I completely agree. I mean, but these numbers, they're just numbers on paper, right? Things that we can't even fathom. A couple trillion stimulus pumped in, and it is what it is. But I mean, the more I look, so it's always a trade-off. If you're either in dollars or you're in another currency or gold or some other placement, I suppose. But the fiscal situation is pretty ugly in most other countries. I mean, so looking at the dollar and the fiat alternatives, I mean, is there any kind of shining light that you're seeing, or it's just kind of the death of fiat as well as the dollar being overvalued?
Well, I think, namely euro and yen. That's not to say that I want to own those currencies, but it's also one reason why probably emerging market equities are, attractive, not just because, like I mentioned before, they're cheap, relative to their own history. The currencies are also cheap. So a dollar bear market is usually good for, those types of investments, that are priced in other currencies. So I do think, emerging could benefit from a dollar bear market like that. But typically, if I'm trying to hedge my dollar exposure, I'm going to want to own precious metals. I think you look at that dollar bear market that I was referring to, that went from essentially from 2002, 3 until 2009, 10. And, that was a wonderful period to own gold. And so I do think, I've been bullish on gold since late 2015, really, when the Wall Street Journal called it a pet rock, and it was the most hated asset class on the planet. It's had a really good run since then, and I'm not as short-term bullish on gold as I have been for that reason. I do think it's probably gotten a little bit overheated in the short run, but longer term, if you're looking to protect yourself from a dollar bear market, I think you have to have some exposure to precious metals, and namely gold.
Yeah, and I've read that gold exposure in portfolios is at all-time lows, and whether this is a byproduct of all-time high equity valuations, probably. But I think there's certainly some upside. Completely agree. Near term, I mean, we've had a fantastical run up this year, but I think longer term, with the fiscal situation and the dollar situation, I think it makes a lot of sense to add to a portfolio. In terms of, I mean, dollar rates low forever, yield curve control, what are your kind of thoughts on where this goes from here?
Well, it's really interesting. I think the Fed is kind of boxed in is maybe not the term. The term is fiscal dominance. The Fed is being forced to monetize the debt now, and I think that's a very important distinction. That quantitative easing in the past was kind of a discretionary policy. The Fed said, we want to try and boost the economy. We're going to do this by, buying treasuries, and that will hold interest rates not just down on the front end, but we're going to hold interest rates down across the curve, make it more attractive to borrow and spend. But also it's going to force investors out the risk curve that if they can't make money in owning long-term treasuries, we're going to have to go buy corporate bonds. We're going to have to go buy stocks. So this was a conscious policy by Ben Bernanke to try and create a wealth effect, and also try and boost the economy by lowering interest rates across the curve. The buying of bonds today by the Fed is not so much a policy that's in line with that quantitative easing where they're trying to create a wealth effect or anything. I think when the repo fiasco happened, almost exactly a year ago, that to me was a sign there wasn't enough natural demand in the market for treasury bills. It comes back to this deficit. We have this $1 trillion deficit. Treasury has to issue $1 trillion in new debt to fund it. And if there aren't enough buyers, interest rates go way up. So what happened was a bunch of hedge funds said, we're going to borrow money in the repo market. And we're going to leverage maybe 10, 20, 30, 40, 50 to 1. And we're going to buy up these treasury bills because we can make, if we leverage it up, we'll make money on the spread. But without these hedge funds buying tens of billions of dollars of treasury bills, there probably wasn't enough natural demand to soak up all of that new debt issuance, and interest rates would have gone up. So when we had these problems in repo, and these threatened to blow up all these hedge funds and create potentially another financial crisis, the Fed had to come in and say, we're going to fix repo, we're going to start buying treasury bills again. We're going to start funding the government directly. To me, that was a change of, we're not doing this for quantitative easing. We're doing this because there's not enough natural demand for all of this new debt issuance. And to me, that's a huge change, because this situation of fiscal dominance where the Fed is now forced to monetize the debt to prevent interest rates from going higher is the type of situation you get when people start to lose faith in the currency. So people will start saying, oh my gosh, they're going to, they have to raise 4 trillion additional and the Fed's going to monetize it all. That's hugely inflationary. And if we own treasuries and we're going to get paid 50 basis points on owning a 10-year treasury note, and you're basically now telling us you're going to try and create inflation over 2% and you're going to monetize the debt in order to do that. This is how you get a bear market like I'm talking about, where people just say, okay, there's no point in owning 10-year treasury notes getting paid 50 basis points when they're trying to create 2, 3, 4% inflation, and they're going to monetize the debt in order to do it. And so that's when you get people liquidating and the dollar goes down, and you can create an inflationary problem. So I think that this is why I've said the dollar is probably the only thing that has the ability to take the printing press away from the Fed. Because if the Fed decides we're going to monetize 4 trillion, we're going to just, however much the government does, we're going to monetize it. The dollar will tank, and the Fed will be forced to say, okay, this is a sign inflation's coming. We can either continue doing this, or we have to change somehow. And it's a very dangerous, I think, and scary situation that could be coming, because if the Fed doesn't monetize it, interest rates go way up, and that maybe means that the Treasury can't even service its debt without issuing new debt. And if they continue to monetize it, the dollar could, like I said, go down 30-40% in value, and that could create a real surge in inflation. And so it's a very, very interesting time. I remind people that may you live in interesting times is a Chinese curse, not a blessing. And so we are living in interesting times right now.
I like it. It certainly is a curse, though. And this fiscal dominance in this corner that the U.S. dollar and Fed and economy has been backed into, you talk about losing faith in the treasuries and these sorts of things, and the dollar going down by 30-40%. Gold will go down as well. This is almost an apocalyptic sort of scenario, right? So, I mean, how does an investor think through this? Obviously bullish on gold and precious metals, but like that almost sounds like a guns and ammo and bunker in the back sort of situation. So how do you think through this?
It's not investors? Nearly as apocalyptic as I'm making it sound. Probably the dollar's had bear markets of 30, 40% in the past, and it's not even lost its reserve currency status. So you can have a 30, 40% decline in the dollar without, having, these end of the world, types of scenarios. And this happens, right? I mean, part of this is also, goes along with the, global hegemon through history, right? We saw the British Empire and the value of the pound, decline dramatically after it became so indebted through World War II and lost its status. I think this is also why there's all this strife with China, because China is in a better place financially than we are. They also they're growing a lot faster, and that can, that growth, economic growth, can solve a lot of problems over time. If we had that type of growth, we wouldn't need to create inflation to get out from under the debt that we've created. But I think the Fed realizes there's no way we're going to grow 6% a year like China. We'd be lucky to grow 2-3% a year over the next 10, 20 years. And so it's going to be very difficult, if not impossible, to grow our way out of this debt mess that we've created. So inflating it away is really the only way, the only solution. So I don't see it as something that's super apocalyptic or anything like that. I just think it's something that's happened throughout history to major countries. And I think the biggest thing that I look at in terms of this is the Fed's either going to have to allow for inflation to really take off, like much more than they're talking about, or they're going to have to let the stock market go and rein in inflation. Not going to be able to have their cake and eat it too. So you either let inflation, run crazy because you're, printing money to monetize the debt and trying to support stock market, corporate bond market, and the treasury market all at once, and inflation goes nuts as a result. Or you say, we can't let inflation go nuts. We have to rein in some of this money, the money printing, the monetizing the debt. And, if you do that, then that removes that floor that's under asset prices. And so, I think it's a question of which one of those two scenarios. And I do think it's probably likely that they get both, that I think that we could see a stagflationary bust in the stock market, where we get weak growth, rising inflationary pressures, and the stock market rolling over all kind of at the same time. And that's just something that could, that's kind of a third possibility, I guess. And I think it's probably the most likely.
Yeah, and I think, I mean, how important and prevalent this wealth effect is in the stock market going up and people's portfolios going up. I find it really hard to believe that they just pull the plug on the stock market and let it kind of drift down to valuations that make sense. So this is kind of my thought of always having stock market exposure, no matter how bearish and how much I want to be 50-50 gold and dollars, right?
Well, I would just say to your point that it's really tough. It's all of this new debt makes it very tough for the Fed to actually prop up the stock market. So people point to liquidity, all this Fed liquidity is what's propping up the stock market. But like Stan Druckenmiller, talked about back in, I think it was March or April, it's not just Fed liquidity you have to look at, it's net liquidity. So it's the amount of money the Fed is printing, less the amount of new debt issuance coming out of the Treasury. So, right, so when the Fed was doing QE before, if the fiscal authorities were doing nothing and the amount of the debt was essentially staying the same, any buying the Fed did reduced the supply of financial assets and therefore made them more valuable. And that was how QE worked to support the stock market over the past 10 years. But now with $4 trillion of new debt coming from the Treasury, that's $4 trillion. That's the almost anti-QE. That's the opposite, right? That's $4 trillion in new securities, new supply of securities that, all else being equal, makes all of those securities less valuable and should push the prices of all of them down. So the Fed has to soak up all that $4 trillion of new issuance just to have a net neutral liquidity situation. So this is where I think it's getting really interesting, because the Fed expanded its balance sheet by $3 trillion, in March, April, May, and since then they've done nothing. The balance sheet has been flat. the Treasury now needs to issue $2 trillion of new debt before year end. So if the Fed doesn't soak up that $2 trillion, then that's $2 trillion of essentially negative QE, with the supply of financial assets growing. So that's almost like, negative liquidity coming into the market before year end. So I think this is a really important time. We're watching the markets and there's lots of things going on, but I think part of it is this market trying to price in, is the Fed going to mop up these excess securities, or are they not? Because if they don't, that negative liquidity situation can be very bearish for equities.
We have to just insist on more Robinhood traders buying it up, right?
Right.
I mean, my thought is, if inflation goes rampant, like the stock market goes up, right? Because people don't want cash, they'll put it anywhere. You look at Venezuela stock market as a most extreme version of it. So it's certainly interesting.
Yeah, there's
times.
gradations of that, right? So if interest rates from whatever 0 to 5, 6, 7, 8% inflation, that would probably be very bearish for stocks, because people would go, wait a second, I can go buy a 10-year note or a 30-year bond and get 5, 6, 7, 8% risk-free. All of a sudden now, if I'm discounting low interest rates for Apple and all these other stocks, now those low interest rates are gone, the valuations decline dramatically. But once you get up into that hyperinflation, you get up in teens inflation and stuff, that's why I think you need to pay attention to earnings, because that hyperinflation will start showing up in earnings. You'll start seeing it in copper prices, you'll see it in commodities markets, and you'll see it in earnings. And until you see it in earnings, you're not going to see it in stock prices. I think these people who are saying, that stocks are starting to discount hyperinflation, to me, that's another just irrational justification for current valuations. Because I believe there would be a period where we would go from 0 to 3, 4, 5% inflation and interest rates. That stage would be very bearish for equities. If it goes into hyperinflation from that point, that's when people would say, oh my gosh, I don't want to own anything except, real estate, gold, stocks, things that are going to somehow preserve their value. But there's an in-between stage there that we shouldn't forget about.
Yeah, that makes a lot of sense. And at that point, I mean, it's literally anything but dollars or fiat currency. So
Right.
Perhaps a good transition into commodities here. I mean, I think you're pretty bullish on commodities in general for the average investor getting exposure to commodities. I mean, are there certain types of ETFs? Like how does one get exposure to commodities as a whole?
Yeah, well, I think, one of the charts I've been looking at for the last several years, and this was related to the gold trade, from 5 years ago, is that commodities valuation relative to financial assets is the lowest in history. Another way of saying it is financial assets are more overvalued than in history. So there is an opportunity in commodities for the long time. To me, it's incredibly ironic that we have the most inflationary monetary and fiscal policy in the history of our country. At the same time, we have a Fed who's telling us they're hell-bent on raising inflation. And what's the most hated asset class on the planet? One of the asset classes that would benefit most from inflation. And to me, that kind of mixture of fundamentals and sentiment, creates a very interesting opportunity for long-term investors. Now, I don't have a lot of interest in owning commodities directly, but owning commodity-based companies who produce commodities or related to commodities is a much more interesting idea, because those stocks are, if there is a group of value stocks in the U.S. stock market, it's these companies that are focused on commodities. So what is the most important commodity on the planet? Oil, right? What is another good commodity? What commodity, aside from gold, did very, very well from 2001, 2 to 2008, 9, 10, when the dollar tanked? It was the oil price. The oil prices, went nuts. It went from $10, $20 a barrel to 100 plus a barrel. Most of the time, the oil price is just, inversion of the dollar. So dollar goes down, oil price goes up. So I do think we're very close to if not already seen it, a terrific opportunity in energy. To me, we're going to look back on this decision that S&P Global Indices manage the Dow Jones Industrial Average, and they made that choice to kick out ExxonMobil, which has been in there since the original Dow 30. ExxonMobil is one of the original Dow 30, and because energy was too big of a weighting in the Dow, according to compared to the S&P 500, and tech was going to be too small after Apple's stock split. So let's add Salesforce.com, trading at a 0.5% free cash flow yield, and get rid of ExxonMobil, which is paying an 8% dividend yield. To me, we're going to look back at this and go, oh my God, they did the exact opposite. And that's exactly what all investors are doing right now. I want to own no energy, and I want to be long, super heavy tech. And I think probably what investors should be doing is the exact opposite of that. Super underweighting tech today, overweighting energy, because I do think energy is going to, is very undervalued right now. It's out of favor, and with the macro dynamics for the dollar and stuff could probably be very supportive for oil prices and for these stocks over the next 5 to 10 years.
Okay, so on a longer term basis, I mean, short term momentum traders like throw it all in Tesla or whatever these people do, right? But longer term, bearish on the dollar, and all of these tech stocks and everything. So the value play there is more for these oil producing stocks, something like Exxon or the Spider XLE, I think. So these might be interesting plays. But with oil, I mean, one of the main headwinds, and I haven't jumped into this that much, would be like renewable energy, right? So this is kind of guessing that we continue the way that we are with a lot of demand for oil. Do you think through those as risks as you're kind of putting on these oil plays?
Absolutely. And to me, the way you make money in the market, this comes from a terrific book from Howard Marks, The Most Important Thing. Terrific book. The way to make money in the markets is you have to have a non-consensus view about value, and you have to be right. And so what is the consensus today? The consensus today is I want to own alternative energy. I want to be ESG. I want to own Tesla. And basically the consensus is that these alternative energies are going to dominate, and they're going to take over, and oil is going to go bye-bye. Oil's just, the demand is going to disappear. That's what I believe is priced into the markets. So the only thing I need to make money in energy is that oil doesn't go bye-bye. If oil doesn't go bye-bye, because that's what it's pricing in right now. If oil sticks around for another 10, 20, 30 years as some sort of an energy source, then then those stocks are underpricing that reality. And so to me, that's how I look at it. I mean, it could well be true that, and I actually don't doubt it at all, that alternative energy sources are eventually going to, but it's all about the time frame. I think people are pricing in that we're not going to be 5 years from now, we're not going to be using oil at all. And that to me is, ridiculous. We're going to be still using oil. I mean, how do you think people power their Teslas up with, electricity that was generated through natural gas or, some other type of thing? It's still mostly created, by those types of sources. And, wind and solar are nowhere close to being able to replace those types of energy. Now, nuclear is another interesting option, right? And so this is another area where, uranium stocks are, been extremely cheap for a long time. I don't own any of them. I'm not betting on, uranium and nuclear, but that's another area where I think if you are an ESG investor and you're betting on renewables, it might be a great time to bet on nuclear, because those stocks are, I think, still probably very undervalued, and that might be the only bridge between, the true bridge between, fossil fuels and renewables.
Yeah, that makes a lot of sense. So I'm curious, and I've heard you talk briefly on it. What are your views on other alternatives outside of these things that we've been talking about? So you only have a finite resources where you can invest your investable cash, something like crypto, completely not a store of value, speculative asset. What are your kind of views on that?
Yeah, no, I do think crypto is, yeah, just a tool for speculation. I think the reason I don't think it's a store of value is because it is man-made. And if you look at just Bitcoin over the last, I mean, you can talk about crypto, and I've talked to some very smart people about this, for the past several years to try and understand crypto. And for a time there, they were constantly coming up with new cryptocurrencies to own, right? First was Bitcoin, then Ethereum, and then right you get to Dogecoin and all these kinds of like crazy things. And to me, that right there is a sign that, okay, well, what if they create a crypto that's better than Bitcoin, that's better than and a lot of smart people say Ethereum is a better option than Bitcoin. And so I've asked smart people, and they say, well, I'll just buy all of them, all of the new ones that are, even just with Bitcoin forking into different, different slight variations on the original, they're doubling the amount of Bitcoins in existence. Yeah, these Bitcoins are slightly different than these, but that's not a store of value if you can just literally branch off and double the supply of something overnight because you have a disagreement in how Bitcoin should be, but should be managed. And so you can't do that, with a store of value is something that is a finite resource and it's not man-made in my viewpoint. I do think there's just way too much risk in terms of Bitcoin, in the fact that I think I said in the Macro Voices interview, the history of technology is that somebody comes up with something and then somebody else one-ups it, several years later and creates a better version of that. And I don't see, why there won't be a better version of Bitcoin. And not just that, why there won't be a better version that will actually be endorsed by central banks, and then controlled by central banks and managed according to their views on what a currency should be. And so, yeah, I just, there are too many what ifs there for it to be something. Gold's been a store of value for human beings for 5,000 plus years, and there's nothing to change that I can see on the horizon. So I'd rather stick with the real thing than Bitcoin was created to try and be a digital gold. I'd rather stick with the real thing.
Nice. Now I've got another podcast coming up that's strictly more Bitcoin bullish, so I won't dive down that rabbit hole. I think I think the worry here is that, like you said, there's a central bank digital currency, and they take all of the characteristics of Bitcoin and they push this out, and this is the new digital dollar. And I think this is the inevitability that we're going towards. You can push monetary policy directly through. Automatically you can have things that expire, so you have to spend them on certain things, and this UBI could all be done so much easier. So I think that's where we're going, which Bitcoin could offer some alternative, some opt out to that sort of system, which is interesting, to say the least. But I won't go too far down that rabbit hole, because
the only thing I would say to that too is that they have outlawed gold ownership in the United States in the past. There's no reason why they couldn't outlaw Bitcoin ownership once they create a federally approved alternative. And so I don't know. There's just too many things like that that make it too risky for me. That said, I know a lot of people who've done really, really well, and a lot of smart people that are bullish on Bitcoin. So I've been very wrong on things like this before. So I just think with for me, I am kind of geared towards far less speculation on things than things that I feel like, I just look at all the great traders through history, great investors in history. And the first thing that, play defense first. Ben Graham even wrote about, you want to make sure your principal's protected. And how do you do that? Through value investing, you do it through margin of safety. I'm going to buy something far cheaper than it is, so that if it turns out I'm wrong, and this thing I paid 50 cents for, and I thought it was worth $1, it turns out I'm wrong, and it's really only worth 50 cents. How much risk did I take? And I don't have a way to apply that framework to Bitcoin, to say, how do I protect my principal? How do I know this thing can't go to, down 90%? And I don't have a way of kind of giving myself that type of peace of mind.
Yeah, that makes sense. And I mean, there's incredibly smart people on both sides of it, right? And this is why you have a market with buyers and sellers. There's
Absolutely,
people
yeah.
that feel very strongly one way and very strongly the other. So there's a buyer for every seller and vice versa. So I get this question a lot from, I think about somebody like my dad who is, thinking about retiring. He's had money in equity, primarily in equities for the portion of his life, like most Americans, owns a house, so he has that equity. But like for somebody like him, bonds are not an alternative. The 60 portfolio is dead. How do you get income? But whenever you're talking to people like this, shorter time frame, need for liquidity, they want some yield, what do you talk to them about? Like, where's the alternatives for something like this?
Well, I think there are so many obvious alternatives to TINA, to 100% in the stock market, right? There's so many less obvious alternatives to a 60-40 portfolio. But I think, the one thing, maybe the biggest mistake investors are making today is, focusing on the US equity markets. That diversification is so powerful. And when you look at, I would recommend, I recommended it for years, go look at Meb Faber's global asset allocation. And he talks about he shows you what a really diversified portfolio looks like. And when you see that, and you see the most aggressive asset allocators on the planet maybe have 25, 30% of their portfolios in US equities, that should be a wake-up call to investors, because the average US investor probably has 60, 70, 80% of their portfolio in US stocks. And so when you tell somebody that and you go, you know what, you are twice as aggressive as the most aggressive asset allocator on the planet. I'm talking about the most successful asset allocator. I'm David Swenson, Yale Endowment, probably, I think typically 30% in US equities. Today, he's closer to 1-2% or zero. But for a permanent portfolio, he's going to have 30% roughly in US stocks. And then you can take those types of permanent portfolios from Ray Dalio, from all these different guys. None of them have anywhere close to 60, 70, 80% in US stocks. And the reason is because you're putting all your eggs in one basket. And yes, that's how Stan Druckenmiller was so successful. He said, I'm going to put all my eggs in one basket. I'm going to watch that basket super closely. And if the market starts to roll over, he's not only going to get out of the stock market, he's going to get short. So how many people, these typical American US investors have the ability to trade like Stan Druckenmiller? They just don't. And so there's no reason at all to have as little diversification as they do. So I think, when you look at these things and you go, maybe 1/3 of my portfolio in equities is where I should be in terms of volatility and, my temperament, my risk appetite. Then maybe 15%, half of that should be in US and half of that should be overseas equities. So maybe you're only 15% in US equities once you start looking at a diversified portfolio. So I think that's the first thing to introduce anybody to, is that, this whole idea of you need to put 60, 70, 80% of your money in the US stock market is extremely risky at any given time. And it's never been more risky than it is today. So there are so many other asset classes to own, and to build a truly diversified portfolio means reducing a lot of exposure to US equities and increasing it to a lot of these other things we were talking about: gold, foreign equities, bonds, real estate, etc.
Yeah, that makes a lot of sense. And then it's actually even more risky for that, right? For the average U.S. investor who is receiving a U.S. dollar salary, who owns a U.S. Real estate. I mean, you are talk about all your eggs in one basket. I mean, it's like working at Enron and getting all of your compensation through Enron stock,
Right.
right? Like those people were
Yeah.
decimated. So it's the same.
Yeah.
I have another podcast all about flag theory, which is kind of global diversification, owning property in different countries with exposure to different FX and all of these things. So it's an interesting thought experiment to go through. My thought there, though, like some of these other guys, they have access to private equity and VC and some things that are a little bit more difficult to get exposure to than the average investor. But you still think there's enough options to truly build, a super diversified globally asset allocation with the tools that are out there?
I do. I think the good thing about this passive bubble is that it's created a bunch of super low cost products that give you access to um, you know uh, there's an index for every country outside the United States. There's X, you can buy an ex-US equity index. There's all types of emerging. Some of my favorite, I guess they're not technically passive, but low cost index type of products are the fundamental indexes created by Rob Arnott at Research Affiliates. And it's essentially a way to put together an index portfolio, but instead of weighting by market cap, you're weighting by fundamentals. So you're weighting by book value, sales, these types of things. So you're not going to be buying the Sun Microsystems, putting a ton of your money into Sun Microsystems at the top, and you're not going to be selling ExxonMobil today. You're going to be probably having a much bigger helping of ExxonMobil in that index today because its sales are still really high. And you're not going to be buying tons more Apple today because its valuation went up, even though its sales have been flat. So it's a fundamental index. To me, is a brilliant innovation. And I think you can buy a fundamental emerging index, fundamental overseas index, fundamental U.S. index, fundamental small cap, and it's basically just I believe a much more efficient way of building an index. And so, yeah, I think utilizing those types of products, you can get massive diversification, not just outside of the United States, but you can be more well diversified within the U.S. because you're not putting 26% of your money in the FANGs. That index, the fundamental index, is going to be much more diversified than a market cap weighted index will be.
Awesome. And I'll definitely link that in the show notes, fundamental index portfolios. I haven't looked into those, so I'm excited to go down that path. Um, I, so next question was more on following your Twitter and your blog, the breadth of information that you're consuming. So what tools do you use to stay on top of things within the financial markets? Because you cover a number of different things. Obviously, it's from years of it being in the business, but more for my own learnings. I mean, but how do you do this?
Yeah, so it's a good question because I have spent years refining my daily routine. So I have a number of blogs that I still follow just through an RSS feed that I find value in. But I think I also use Apple News. That's curated to specific topics that I like. But I think the most valuable thing that I've found over the last several years is, I follow, I think, just about 100 accounts on Twitter. And these are only people that I, find provide me with terrific value, whether it's charts or articles or whatever. And then I found this app called Nuzzle, Nuzzel. And Nuzzle takes all of those 100 accounts, and it will show me the articles shared by those 100 accounts, and they'll rank them by popularity. So if 3 of those people shared the same article, that comes up first. So it'll give me like 50 articles a day based on what my network is sharing and based on popularity. And then even more valuable than that sometimes is it takes those 100 people and their network of people they follow. And so there's another, so I can see the friends of friends all the news articles that those people are sharing. So basically, Twitter has created a network for me that's kind of like a news gathering organization. And so when I go to this Friends of Friends tab on Nuzzle, it shows me this whole, FinTwit network of people that, that I value and that they value, and the most important things they're reading over the last 24 hours. So that's my
Wow.
secret.
Awesome resource. No, I haven't heard of
Yeah.
that one, so definitely putting that on the list. My biggest worry with Twitter is I'm just stuck in my echo chamber, and this just is an accelerant for this echo chamber aspect. I mean, if you look on my Twitter feed, I mean, everybody is short the dollar, super long gold, and they love Bitcoin. Like this is the area that I play in, right? So I always want the differing opinion. Somebody say, no, Bitcoin's dumb. Like they'll just fork it, right? It's not
Yeah.
limited. So
Well, that's one of the things I use Twitter for too is for sentiment. I mean, that's one of the reasons why I think, I've been short-term bullish on the dollar and bearish on gold, is because I think sentiment got way too far extended, and there are way too many dollar shorts right now. So when I say I'm bearish to the dollar, I'm talking about the next several years, but we could have a good short-term dollar rally that kind of coincides with this risk-off period where you get people selling stocks, kind of going to the dollar as a safe haven again over a short period of time. And that's also why oil, and oil stocks are selling off as part of that trade also. So the short-term dynamics, I think Twitter is fantastic for sentiment. Also, a lot of the stuff I'll tweet, is not even stuff that I believe. A lot of the times it's just quotes that I'll put out there that I find interesting, and I want to see people's reactions to them. When they say, hey, when people like get super riled up about something, I know, okay, well, sentiment's gone pretty extreme to one side or the other on this topic. So we saw it, especially when it comes to the dollar. It's fascinating to watch. We had that dollar spike, back in March or whatever, when the stock market tanked. And some people just got so bullish, dollars. They were like, here comes the huge dollar blow off, right? And over the last 2-3 weeks, we've seen people getting, like when people start patting themselves on the back too much for being bearish the dollar, okay, we're time for a counter trend rally at least. So yeah, Twitter is a terrific sentiment tool for that.
it is, but I just always, is this reality or it's just my tiny little echo chamber? So everybody's bearish on the dollar. Is that actually representative of the greater investor sentiment? I mean, I don't know.
Right. Well, that's also why I do so much reading too, is because, when you see the mainstream media, start coming in and saying, and we did see that over the last couple of weeks. We saw a lot of the mainstream media questioning the dollar's reserve currency status. And so mainstream media is for me an important sentiment signal too, because the dollar's down, 5, 6, 7%, and it's going to lose its reserve currency status, right? That's a little panicky. It's got, and so I those are typically mark the short-term bottoms. But yeah, you're right. I mean, it's hard for me because everybody I follow on Twitter, I have huge respect for. And so when they, are all kind of sharing the same opinion, I'm like, they're probably right. Is this a contrarian view? But this is just, I only follow contrarians, so it's tough. But for me, I find much more value in following those people and hearing their ideas and input than I otherwise would.
Nice. So I'll definitely link your Twitter on in the show notes and felderreport.com. But last question: if you could only follow 3 Twitter accounts and not use a cool tool like Nuzzle, who would you follow and why?
Oh man, who would I follow?
Put those guys on the spot.
Jason Gebfert, sentiment trader, is somebody that I've followed for a long time. He does some just brilliant sentiment work. Gosh, who else? Let me just look and see who I'm following here real quick. I got to go back to the people I've started following a long time ago. Helene Meisler also is another one who I think she's just brilliant chartist. She's been hand drawing charts for decades and just has her finger on the pulse of the market. That that to me is invaluable. And then third, Gosh, I probably need to just say my friend Peter Atwater. Peter is, professor of socioeconomics, and just his take. He has such a unique take on how things are unfolding in the markets, and how it relates to sentiment, not just investor sentiment, but popular sentiment, and consumer sentiment, and these types of things. He has such a unique perspective. He's so underfollowed. I mean, he's one of the most brilliant people I know. So yeah, go follow Peter Atwater. But yeah, those three to me are three of the most valuable that I follow.
Awesome. I'll definitely link all of those guys. I'm surprised to see 2 out of the 3 as chartists. I mean, coming from my CFA background, I mean, charting is just voodoo, witchcraft, maybe a like tactical shift, but that's quite surprising. But I'll definitely.
Helene is a pure chartist. I would say Jason is more statistician. His more just sentiment related statistics and price related statistics. I mean, there's so many people that do it now. There's so many imitators, but Jason's been doing it for 20 plus years, and he's got it so dialed into what's valuable information, what's not valuable information. And so, yeah, I wouldn't throw him in the charting category so much as this statistics category.
Awesome. Well, Jesse, really appreciate you taking all the time today. What can you leave my listeners with? Where do you want to send them to find out more about you and what you're doing?
Well, yeah, I mean, you probably get a good idea of what I'm thinking about and reading, and just from following my Twitter account. It's just at Jesse Felder. I basically, I told you my routine. Every morning I go through all those things, and I pick out the articles that I find that whether it's important information or it's important, sentiment signal through, from several media outlets or certain dynamics going on. I'm trying to track the narratives really that are driving the market, and what stage those narratives are in their life cycle. A narrative that's kind of in an early life cycle, something you can trade off of, vice versa. If something is getting ready to, meaningful to the market, that's an important signal too. So, my Twitter account might seem like I'm not explicitly saying those things, but I'm sharing those articles and charts and things because it's very highly relevant to a narrative that I'm tracking that I think is important to markets at present. So
awesome. Well, it's definitely a treasure trove of information and highly curated of all the different articles that you're going through. So we all appreciate that. That's for sure. And I'll also link, you have a newsletter that comes out on the weekends at the felderreport.com.
Right. Yeah. That's right. I take like 5 things, that I found during the week, and I put them in that free Saturday morning email. So yeah, you can just felderreport.com. You can sign up for that and see what 5 things I thought were most important from the last week.
Awesome. Well, Jesse, really appreciate you coming on. Lots of great information in this. I think my listeners are really going to love it.
Awesome. It was a lot of fun. Thanks for the invite.
Thank you. There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.